Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree, Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. There's been a new topic circulating on the internet for the last several days. We need to examine this because it comes from a famous investor, who's none other than Ray Dalio, who makes significant statements that could impact all of the investors. On May 2nd, he declared that the stock market was on the verge of a bubble comparable to the dot-com disaster in the Great Depression of 1929. He said that bubbles like this can be classified into 6 groups that have been seen throughout history, which seems very similar to what we're noticing right now. This also happened at a time when the stock market was off to its worst beginning since 1939. The survey indicated that individuals are more pessimistic about the stock market today than they were at the beginning of the COVID-19 pandemic or in 2009. Let's look at what this all implies and how our current market relates to the past bubbles in history. Although let's talk about Ray Dalio first. I know you already know him, and if you are wondering why there's so many people who listen or who are interested in every bit of his statements, well, he's currently managing the Bridgewater Associates, which is the world's largest hedge fund, established in 1975. Bridgewater has expanded to manage over $140 billion throughout that time, frequently outperforming the S&P 500. Ray Dalio has gained over 45 years of macro investing experience during some of the market's largest boom and bust cycles. Because of this, he's led people to believe that we are in the midst of a bubble, and he's divided it down to 6 categories. The first one is high prices relative to traditional measures of value. Second is unsustainable conditions, such as trying to extrapolate past revenue and earnings that cannot be sustained. Third, many naive and ignorant buyers who were lured because the market went up. Fourth is broad bullish sentiment. Fifth, a huge part of the market is financed by debt. And lastly, the 6th one, a large number of forwarding and speculative purchases were made to bet on those price gains continuing. We've seen some of the highest valuations on record businesses in recent years, with new investors buying in based on unsustainable past performance. Bullish sentiment peaked at an all-time high at the end of 2021 because of the record numbers from the COVID-19 shutdown. 6 months ago, margin debt hit a record high. Others may say that because stocks only go up, there were a lot of interesting things in investing. So a lot of evidence supports Ray Dalio's theory that the market is in a bubble that will burst the time you decide to start investing. The main reason is that in January of this year, he pointed out specific firms' exorbitant valuations, which eventually proved to be correct. He highlighted that the bubble indicator was nearing 70% of the peaks seen in 1929 and 2001, indicating that some equities were super overvalued and on the verge of collapse under the right conditions, or maybe the wrong conditions if they triggered them to crash. They were about to crash in either case. Investor sentiment was excessively positive, and IPOs were at their highest level since 2001, as fewer purchasers entered the market. But the stock market has burst since the first article was published, and he was right in calling them out. He does, however, point out that bubbles can take a long time to unwind, and that just because they aren't at a maximum bubble doesn't indicate that they're safe or that now is a good time to go in long. In reality, our metrics still show that US stocks are overvalued. As he implies, once a bubble bursts, the trend continues downwards, and in this case, most recent bubbles have settled around 20%, giving us a little more space to fall. Developing technology has taken the same course as both 2001 and 1929. The major question now is, how do we compare to the rest of the market, where prices have dropped anywhere from 15% to 70%? He shows that the market is high but falling in comparison to previous bubbles. The price-to-earnings growth ratio is also high, but as fewer new investors enter the market, prices have begun to fall. Forward growth currently indicates that there may be more room to fall, but the biggest surprise is that bullish sentiment is at an all-time low. Here's how the last point is so intriguing. According to studies, the more people assume there will be a market crash, the more likely the market will do the opposite thing and not crash. And besides, the start of a recession normally occurs after peak joy, not peak worry. Thus, when consumer sentiment plummets and bullish sentiment reaches an all-time low, it's usually a solid sign that now is a good time to invest. Take a look at the data over the last 60 years. Large drops in consumer sentiment result in a 23% increase in the S&P 500 over the next 12 months. We also have this thing called the US Crash Confidence Index, which measures investor sentiment and how likely they believe a crash will occur. This is vital since the majority of evidence shows that the average investor is usually incorrect on most critical aspects. And if the ordinary investor thinks prices are set to skyrocket, it's usually an indication that things are about to get worse. The more concerned investors are, the more likely we are to have bottomed out. And now that we've started to trend downwards, this could be an indication that we're ready to witness a reversal. This is matched by the Warren Buffett Fear and Greed Index, which shows that the market is currently being driven primarily by fear, especially as it trades considerably below its 125-day moving average. Although it appears that we are nearing a reversal. And before we discuss what this means for all of the investors and whether or not Ray Dalio believes we're still in a bubble, we first have to discuss the well-known phrase, sell in May and go away. So in terms of that phrase, do you believe it's true and that the month of May is an excellent time to sell? The phrase is claimed to have come from an Old English saying, sell in May, when merchants and bankers in London's financial district realized that their investment returns were lower in the summer. However, in the modern era, it is believed that the stock market underperforms over the 6-month period between May and October. But is there any data to support this? Actually, it turns out that there is. It is true that between Memorial Day and Labor Day, investors are more likely to go on vacation and take time off, resulting in less market activity and negative price pressure. So according to one data, the average May return has been negative 0.1% since 1928. But since 1950, the May through October period has returned an average of positive 0.3%. And in 2021, May returns at 0.56%, up from 4.53% the year before. Another intriguing fact is that while May hasn't always been a good month, research shows that the June-August period, which dates back to 1928, is normally the second best of the year, with gains of 63% of the time and an average return of 2.97%. Stocks have provided positive returns every 6 months between May and October over the past 10 years. So while May doesn't normally do well as the other months, it has done so in the past. And let's face it, attempting to time the market based on an Old English phrase is definitely a not so good idea. In regards to Ray Dalio's statistics, yes, the market is regarded as expensive based on historical indications. But it is a good indication that people are starting to be bearish because irrational exuberance is a lot better at predicting a bubble than excessive negativity. He also stated that the market has more room to fall, with a disclaimer that what one does with this is a subjective decision. He also said that bubbles frequently overcorrect and sell off farther than their fundamentals would imply, indicating that if bad things will happen, prices will get worse, and this could be a great time to buy. The home market, on the other hand, is a whole nother situation. In the same way which most Americans are bearish on the stock market, a new survey says that only 30% of Americans believe now is a great idea to purchase a house, the lowest level since the survey began in 1978, and the first time that less than 50% of the population around the country believe it's a good time to buy. So with negative evaluation, more consumers may opt out of the market, leading to decreased sales, increasing inventory, and finally lower house values. There's also the ongoing problem of home affordability, which is currently at an all-time low. Indeed, with the rates now having risen an additional 50 basis points, the biggest rate increase since 2000, we could hit a new low for housing affordability any day now, as the average monthly payment has increased 72% since the beginning of the pandemic. The emerging problem is that you have several people rushing into the markets to get ahead of mortgage rates with the expectation that if they don't consider purchasing now, rates will go up. We can also notice a lock-in effect in which homeowners do not want to move because doing so would mean giving up a historically low interest rate. Furthermore, rentals tend to be pretty steady over time, even when prices fluctuate. Making consistent cash flow is a good long-term investment. Moving on, it seems that Ray Dalio was right in identifying certain market areas that were significantly overvalued and have plummeted significantly. If everyone was in SPAC IPOs on developing tech during stay-at-home plays, you probably lost a lot of money. But determining whether the broad market is overvalued or not is much more difficult. And just because it is costly in comparison to previous history doesn't mean it can't go even higher. So I think the best solution to all of this is to simply diversify as much as possible in a variety of sectors. Stocks, real estate, cash, and even cryptocurrency are all options. After that, just accept the fact that prices will change for no apparent reason, and it is beyond your control. However, long-term history has shown that markets eventually recover and prices will begin to rise again. And that was today's video. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.